Hey everyone, this is Simon, your crypto CPA from the Lone Star State here at Occam CPA. Well, in today's video, what I'm going to do is I'm going to discuss business crypto journey. So from the time you incept a business to the time you report, whether it's annual tax filings or annual reports to the investors, let's talk about that entire journey and what it takes to get to that point, whether it is just issuing K-1s or whether it is also doing payroll and also contractor 1099s, issuing those, even though you have used crypto to make those payments. So all of that now is part of the general business regime. That means that crypto no longer is seen something on the outside, but yet it is being used as a value or a legal tender of type to then transact and get to the same exact position as you would with fiat or USD. So when you think of reporting and business, bank accounts, transactions, and finalizing your P&L, your profit and loss, and your balance sheet, which then completes your financials for the year, we call it closing the books. That all of it is part of a crypto business now. This is no longer something separate where you don't know, well, we can't transact, I don't have a bank account, no one's gonna open my account, none of that. Now there are banks out there that open up bank accounts for crypto companies. There are exchanges that open up business bank accounts. So then now that entire ecosystem is established. Now you have payroll providers that actually take payroll in crypto, then can convert it for you and also act as a PEO organization, which is a professional employment organization where you can then be part of their pool too and get access to amazing benefits. So now crypto businesses now are basically they're mainstream. They're no longer something separate. So now let's start. And what I'm going to do is I'm going to show you what a typical journey looks like. A business that incepts or starts, incorporates, does all the filings of all the bylaws, the operating agreements. And basically, in this video, let's discuss the partnership style. C corporations we can discuss in another video, but they'll have the same components. But in this video, I'm going to discuss the K-1s too. The K-1s are very, very important because it can show you how that capital gain and loss transfers over to you via the K-1. So now let's start. Okay, close this. So now here is a typical business journey that you see. Or and again, when we say a business, if you have a business activity of any type, it doesn't matter if you have incorporated or not. You can still report on the partnership tax return, on the S corporation you have to incorporate, but a partnership you don't. So just merely shaking hands with somebody, that in itself, the shaking hands, that in itself is an agreement. So you don't need to have written agreements to have a business. In the eyes of the IRS, they are looking at it as an activity. And where is that activity getting reported? So that's what you need to think about constantly. What am I doing and where does it get reported? And then based on those, you can see the ins and outs and what you have, the pros and cons for that particular entity type or a tax return type. So now let's see, okay. So step one, usually we have people on a normal journey, you'll have, let's say a DAO or a NFT lending institution, or a metaverse company that establishes their own metaverse, or a mining company. All of these, and there's so many layers in between. How about a developer that happens to incorporate so then they can have their own S corporation? This would be the same thing. Here you are, step one. You're incorporating, you're getting a company, right? But you don't need to get a company, FYI. If you're getting a company, then you have the umbrella of protection of an incorporation, but you also need to follow the rules of such incorporation, no mingling and all that. So step one, let's get this done. Incorporate. Step two, you're going to go into a bank account, or you're going to go into a bank and you're going to go and open a bank account. Typically, we are doing this locally a lot, but now there are online banks. So you're not really walking into a bank. But the traditional banks, the big ones, still to this day, when you say you're doing crypto, solely crypto work, they might not open your bank account. So then, but cryptocurrency is predicated on blockchain. Blockchain technology is technology, it is IT. So hence, you are in the technology business of some type. So picking an NAICS code that can still fit your structure and your business and what you're doing can then still also be beneficial for some of these non-traditional banks that are taking their sweet time in accepting crypto businesses as their clients. So for the time being, go to a bank like Mercury Online and others that sure they'll charge you per transaction, but they'll open your account and then you can transact. You can do the general fiat withdrawals because you're going to need a bank account to do what? To cash out, to off ramp, to also on ramp. On ramp means what? On ramp means to go into crypto from US dollars. That means from your bank account. So you need a bank account, right? So, and then also cashing out at the end, withdrawing, bringing money back from the crypto world to the regular world, you still need to off ramp. That's called withdrawing, cashing out. So for that, you also need a bank account. So bank account is important. Just because you have a crypto wallet, I've had clients where they've come in and they're like, "Oh, we don't need a bank account. We're transacting. Everything is done on our crypto wallets." No, they have so many general business expenses that they're paying out of pocket, and then we're having to record multiple entries with receivables or sorry payables from the company. No, none of that. Get a bank account. So, and that's it. Once you have these two things, you can start transacting, whether it's receiving money from people, sending money to people, um, receiving crypto, paying expenses, receiving revenue, regular revenue, and also bringing your revenue back from crypto land to US dollars. You still need the bank account, right? And that's where you need your bank. So make sure you follow these three steps, and now you're a business that is transacting. So now imagine the whole year goes by. Let's say you have different wallets, you have different exchanges, you have different business activities in different. You're testing on one area. There's partnerships, or there's different mechanism. Let's say that there are formulas associated with your wallets because you are in the business of cryptocurrency and blockchain, and sometimes there are royalties, or maybe you ought to get paid based on every transaction that everyone else is transacting on an exchange, and maybe you're an exchange owner. So all of those things will become revenue, and they will come to you from one place. So remember, so while you're doing all this general crypto activity as your business throughout the year and your general business activity throughout the year, think about the annual compliance filings, and then also that are more frequently filed, less than annual, such as semi-annual, quarterly, monthly. Think about those things. What could they be? Because if you just think and ponder and wonder, you will get the answers, such as payroll reports, such as different unemployment insurance filings. So you could have multiple components that you also need to be compliant with throughout the year and not just at the end of the year. So make sure you're also filing and doing all those things. And now with crypto payroll, you need to understand that you can certainly pay payroll in crypto, which then is getting converted. So there is this monthly reporting that also needs to be done. So make sure you're doing that and not just an annual tax and just doing your accounting at the end. So what does a profit and loss look like? Let's talk about this. Okay. 1 second. What happened to my right here? So a profit and loss is where you will see your revenue on top, and then you're subtracting all your expenses, and you're getting a general operating profit based on the operating expenses, and then taking out additional expenses that might not be related to operating, and maybe their depreciation or interest or taxes, then that will give you net income. So net income is basically, so anytime you're looking at a profit and loss of a business, look at the very bottom. That should tell you how healthy the business is. And look at the very top two to see what the revenue was like, and then you'll see you can just uh, imply what the expenses were and how good or bad the business is doing just from these 2 points, and then drilling it down further. Because a business that is, let's say, that has a gross margin where you're taking out the cost of goods sold of 40%, 50%, yet when it comes down to net income at the very end, and it drops down to 5% profit, or then you know that you're engaging in non-business activities that are costing you a lot. Remember this. So sales at the top minus direct expenses associated with the sales, such as labor. If you are in technology, if you're in blockchain, that could be a server that you're renting for the particular minting that you're doing. So those are directly associated with it. And then you get gross margin, which is basically a half profit that you're watching just based on your core activity. Remember these things: top of the income statement and then bottom of the income statement. These things are basically telling you, and I'm giving you pro tips. Why? Because then you're able to gauge the health of your business by some of these line items, and knowing what transpired in the middle and what was costing you a lot, what is cannibalizing your business. That's what it is. So this is how a profit and loss looks like. On this, you will have crypto income. This is just a general business picture that I've basically downloaded from QuickBooks. So on this, you will get crypto income, and then you will also have crypto expenses, transferring fees, transaction fees, server fees, cloud computing, all of that. And then you will also have crypto capital gains and losses, ladies and gentlemen. Why? Because capital gains and losses will then shift your tax liability up and down. So you need to remember, crypto capital gains show up here too. So this would then complete an entire picture. This is basically showing you what transpired throughout this 1 year. And if your time periods are less, you can certainly do a quarter and see what's going on. Once you're done with this, you're going over to the balance sheet. So now we've already captured all of our crypto income, crypto expenses, crypto capital gains and losses. All that is captured. Now we're looking at the balance sheet and here you will have your crypto assets that you're investing in. So if you don't have that on your balance sheet, then your balance sheet is not complete. So crypto assets you can think of it as a bank account. It's a current asset account that is liquid in nature. And that should have all your cold storage, liquidity pool assets, all the assets combined. And when you move money, when you purchase more assets directly from the company, you're basically essentially reducing one account, which is both in the asset category, the cash account or the bank account, and then you're increasing the crypto asset account. So then net effect is zero. So nothing is changing on the liability. Just the acquisition, that should be the net effect on your balance sheet. So I'm just giving you all the pro tips so that you know that you've finalized your crypto income statement and balance sheet before you go on to issuing any investor reports and then doing the tax returns. So then once this is all finished and completed, well, we have new forms that are here. You can't just complete all of this. You still need to go and check the new 1099 DA. You're going to get a statement. The form is not going to look like this. It's going to be a statement of assets, and there's going to be a whole lot of line items depending on what you're doing. And basically, anytime you've moved anything back from a DeFi wallet to a centralized exchange wallet, the brokers, which are the owners of the centralized exchange, they're issuing these forms. But then you're not going to get the cost basis and the date for any crypto that you moved back into the centralized exchange. What will that do? Show 100% profit because there's no cost associated with it. Second thing, your taxes, because it is 100% profit, they're going to be high. So what you need to do is take this form, then go back into your crypto accounting data, and then wherever you're doing the subledger of the crypto accounting, where the wallets are coming in, you have to have a central repository, kind of like your QuickBooks, a central repository place where all the wallets are coming in. There are transactions. You're doing different accounting methodology, all of that. That is where you will see the data for cost basis and the date. So then what will happen is you will need to adjust this form with the right data. When you adjust this form with the right data, your capital gains and losses will change, thus impacting your income statement. So you need to make sure that finalization of your crypto financials is not just finalization of those financials all on their own. They're also in conjunction with the forms that you're receiving after the year end. So you need to make sure, otherwise there will be a mismatch, and then the company that's issuing these reports, the investor reports and the tax returns, and the investors themselves, they all will get notices, and this could be a nightmare exercise of audit, and then them having to pay more in taxes later on with fines and penalties. So make sure all that data is finalized. So once it's finalized, we're on this video segment, we're talking about the 1120S. 1120Ss are S corporations, where the owner is also a shareholder of this corporation. So in an S corporation, you have to have a W-2 for the owner. All that shows up here, compensation, line 7. And then while you do this S corporation, you'll notice that after you're done and finalized, this will issue a K-1. I know this one says K-1 for 1065, very similar to 1120S. You will get ordinary business income. You will get different boxes. And then what you need to make sure is that you will have again, this is a K-1 for 1065. So for 1120S, you will have, and I'll tell you, you will have the ordinary income. Then you'll also have the net short-term capital gains and losses and net long-term capital gains and losses. Look at these line items. I have seen so many K1s that have come through from other CPA firms that um, we've fixed, where they've lumped everything in box one in ordinary business income, and that is wrong. That leads to overpaying in taxes because the long-term capital gains rate is low. So if you don't have figures here and they're all here, they're all transferring to you from here. Thus, incorrect reporting and higher tax liability and fees and fines and penalties, all of that. So this needs to be right. This is the output that everyone is looking for, or most people are looking for that are investors and shareholders of a conglomerate or a group. They're looking for these K1s, and these K1s need to have right data in the right boxes. That means you need to have experience of doing these K1s, and then it goes down to you on the personal side, and then it gets logged. Then if you have carryover losses. So now if I come back to partnership, partnership is 1065. And, whenever we talk about partnership, people, it's amazing how now states allow you to have limited partnership entity types. They're absolutely amazing because they really do protect the entity and what it's made for. So 1065 partnership will have the same structure where you have a full tax return. You have that P&L that we talked about earlier that is getting fed into this. And then after, you're getting your K1. And the K1s in a 1065, there is no W-2, there are guaranteed payments. There is no requirement for a partner to have guaranteed payments, whereas in 1120S, S corporations, the owner has to have a W-2. So this could be empty. So box one here again, and look at the net long term and short term. Make sure those amounts are being flowing in properly, because then that amount will go into your 1040. So then Once this is done, finalized, completed, you've checked this against your subledger, your balances tie, your cost basis report looks good. You've matched it against the 1099 DAs. You've issued your 1099 NECs for all the contractor payments that you paid out in crypto. So for the 1099s, the 1096 should have the USD value, and the 1099 should also have the USD equivalent of the crypto. And remember, if you look at some of our other videos, you'll notice that there's a gap between a lot of times when a business owner decides to pay somebody versus when they actually go and press the pay button, especially if it's in a different crypto than USDC or USDT. What will that do? That price difference from the time you decided to pay somebody and from the time you paid somebody, someone will have to take the loss. It's either you or the person who's paying or who's getting paid, sorry. But most of the time it's going to be you because they're going to want their money in full. So make sure when you're deciding to pay someone in crypto, it's recorded on the ledger. You've taken the action, and that action is then recorded on chain right away. And right away, that fair market value and that price is logged into your accounting system. So then you get no mismatch. The data is speaking all over. So there you have it. Now, crypto businesses are full businesses. You have to do full financials, full income statement, full balance sheet, and everything. And once you're completed, then you're still comparing your data to the 1099 DAs because even as a crypto business, you're getting the 1099 DAs. You're matching it, you're reconciling it, you're making any adjustments. The adjustments are then getting fed into your income statement. All the crypto income and expenses are already booked. Then that balance sheet has all the ending balances, and then we are good to go. That completes your financials. And if you are a crypto business that has assets in an exchange that is not US based, non US based, remember the FBAR Form 114 filing. It's just an informational report, nothing else. You need to report that along with your tax return. They're just wanting to know that if you have assets that are in different jurisdictions, how much are they and where are they? That's all. And the reporting is triggered with this. Listen, that at any point during a given year, cumulatively combined in all your non-US jurisdictional accounts, whether they're crypto, retirement, bank, or any kind of accounts that have assets, liquid assets, if you cross $10,000 combined in all of them at any point during the year, that triggers the reporting. So then you need to report the balances as of the end of the year when you're doing the tax return. So the reporting is triggered at any point in the year. So just because your balances could be low at the end of the year doesn't mean that you're off the hook. No, you still need to report because you breached that limit at one point during the year. And that reporting is paramount. You have to report. So, ladies and gentlemen, this is that concludes our mini segment on crypto financials, crypto income statement, crypto balance sheet, crypto K-1s, crypto 1099 DAs, crypto incorporations, um, crypto, you name it, all of it, from general business bank accounts to wallets on the blockchain, then going back from the wallets on the blockchain to cashing out, and that entire journey and what it looks like and how the numbers flow. This is it. I have laid this out to you. I hope you're going to have an amazing 2026 and beyond. Please keep growing your companies. Make sure you get a good CPA in your state that knows crypto in and out. CPAs are still learning. This is a newer topic, so make sure you're vetting them because last thing you want is to have amendments on your tax returns. IRS is watching all of this very closely, so make sure everything's done right. Thank you so much. Have an amazing day and have an amazing year, and file your taxes right and do the amendments right too. Thank you.